A few weeks back, I did a video on 10 popular trading maxims explained. What are trading maxims? Well, a maxim is a saying or a phrase. It's basically some words of wisdom. So this video can be considered a part 2. I'm going to cover 10 more popular trading maxims. Now, these trading maxims, they're going to be things that you will often hear if you hang out in trading communities and forums and chat rooms and things like that. And the reason I make these videos is because even though you hear a lot of these trading maxims all the time, if you're new to trading especially, many newer traders hear some of these phrases, some of these sayings, and they don't quite understand what they mean. And in some cases, they actually misinterpret them to actually mean the exact opposite of what they truly mean. And the first maxim I want to cover today is a very popular one you hear all the time, and that is buy the rumor, sell the news. Now, what does this actually mean? Buy the rumor. Well, buy the rumor means exactly what it sounds like. Buy the rumor, buy the anticipation of something, buy on speculation that some future event might actually take place, right? You buy the rumor. Now, sell the news is when whatever it was you were speculating on, whatever you thought might be a possibility actually becomes an actuality. That's when you sell. That's when you get out of that position. So for a rumor, it could be maybe you're hearing whispers of a company potentially launching a new product or a new drug if it's a pharmaceutical company or whatever it happens to be. There's something that's being whispered about. Maybe it's not just being whispered about. People are actually talking about it on financial news networks and things like that, but it hasn't been officially confirmed by the company. But when the company confirms it, that's when you get out, right? On the rumor, people tend to buy in anticipation, right? That's why you see these stocks have a very big run up on the rumor of the news. But once it becomes official, once the company actually comes out and announces that new product or whatever it happens to be, that's when all of a sudden a lot of selling typically takes place, because then the event is over, right? If you believe in efficient market theory, once the rumor is confirmed, right? Once the news is actually confirmed as, yes, this has actually happened, well, then the price is already baked in at that point. So no longer should you be buying on anticipation of the stock rising any further, right? Again, once the news is official, that's typically where you need to start selling and getting out of that position. Maxim number 2, you can't make money without risking money. Now, this should be obvious. In trading, there are no free lunches, right? You can't actually make money without risking money. If you want to make some money, well, you got to put some money up, right? As risk, right? The greater the risk you take, the greater the potential reward you can make, and vice versa. If you don't actually take any large risk, well, your reward is not going to be very large either, right? So in essence, if you want to make some money, you do have to take a little risk. And this is really all what trading is about. It is finding the right balance between risk and reward. Maxim number 3 is the train has left the station. Now, you hear traders say this all the time when they talk about an underlying asset such as a stock or maybe a futures product. All of a sudden it starts making a big move in one direction or another, and people will say the train has left the station. What does that mean? Well, it means that this underlying asset, a stock, whatever it happens to be, that wasn't really moving much before, now all of a sudden it makes a move, and especially a move really in just one direction, then that is when the train has actually left the station. Maxim number 4 is don't trade on emotions. You hear people talk about this all the time, is that trading should be an emotionless endeavor, right? You need to be mechanical in your trading. If you start letting emotions creep in, you're going to fail as a trader, because some of these emotions, especially hope, fear, greed, and some other emotions, they really hamper your ability to make good decisions. Maxim number 5 is don't throw good money after bad. What this means is don't add to a losing position, right? Don't throw good money after bad. If you're already in a position and it's going against you in a big way and you're losing money on it, the last thing you need to be doing is adding even more risk to the trade by getting a larger position, doing things like averaging down. So when I talk about averaging down, if you're in a stock position, say you own 100 shares of ABC stock and it has declined in price, the share price has dropped 20%. The last thing you should be doing is buying 100 more shares to average down in price, right? Because now instead of having 100 shares of ABC stock at risk, now you're in it for 200 shares, and maybe the stock keeps dropping. Maybe it drops another 20% over the next couple of weeks. And then what do? Well, I'll average down again by buying 200 more shares to now have 400 shares of ABC stock. And all you've done is you've just thrown good money after bad. That position was a real turd to begin with, right? That position was a loser to begin with. And now you keep adding money because it keeps going against you. And it's very possible, especially with stocks. Some stocks do tend to go down, sometimes for years or even decades. Sometimes they go down all the way to zero. So do not sit there and average down and average down and average down. If you get into that kind of mindset, you are going to blow up your account. You're going to go broke, and you're never going to be a successful trader if you get put out of the game. And the easiest way to avoid getting put out of the game is never take too much risk. So remember, don't throw good money after bad. Maxim number 6, trade numbers, not money. What this means is don't get overwhelmed by the actual dollar amount of your positions, your trades. Don't ever really think about anything in terms of actual money, as far as, what I could potentially do with this money, or if I lost this money, how would it affect my life? Don't get caught up in thinking in terms of money. Think in terms of numbers. Everything is just a number. It's a metric. Think of the probabilities. Think of risk versus reward, your buying power reduction, and all of that. Think of everything as really just a number on a screen. As long as the numbers make sense, stick to your mechanics, right? Don't get overwhelmed by thinking about whatever your current financial situation may be. Maxim number 7, don't try to catch a falling knife. You hear this morning all the time, older traders will tell newer traders, don't try to catch a falling knife, because newer traders, they come into it thinking they can predict the market. I always tell you, markets are random. You can't predict anything, but many newer traders especially think they can actually call a top or call a bottom. And this don't try to catch a falling knife, we're talking about stocks that are dropping, they're dropping fast, right? And some traders get it in their head, well, today's the day, it's been dropping, but today's the day it's going to reverse and go back up. So I'm going to go ahead and buy, I'm going to get in this thing right now, and I'm going to catch that reversal, right? They try to catch that falling knife. And just like in real life, when you try to catch a falling knife, you're going to get cut. Maxim number 8 is the bulls take the stairs and the bears take the window. So what this means is, in a bull market, what happens? Well, a bull market, things just gradually go up, right? They stair step their way up, right? The bulls, they take the stairs, right? And what happens when markets all of a sudden reverse on you, and maybe there's a recession, maybe there's a crash? What happens? Well, they don't take the stairs down, right? What do? They jump out the window, right? They go straight down. So the bulls take the stairs and the bears take the window. Sometimes you will hear this phrase also said this way, is that markets take the stairs up and they take the elevator down. Maxim 9, markets crash down, not up. So what this means is, when we're talking about the stock market, the equity markets, it's very similar to what we were talking about with the bulls taking the stairs up and the elevator down, right? So markets crash down, not up, means that on a down move, that's when you get that really big move, that kind of sudden violent move, right? Markets don't ever crash up, right? You're never all of a sudden going to see like a 4 or 5 standard deviation move to the upside, right? That almost never happens. That happens all the time to the downside, right? So the markets, again, the stock market, it tends to stair step its way up, but with down moves, they tend to be much more dramatic. And finally, Maxim 10, trade what you see, not what you think. This is very important. I keep repeating this. Markets are random, right? Markets are random. You can't predict anything. So don't trade based on what you think is going to happen. What you think is going to happen almost never happens, right? Don't trade based on what you think is going to happen, what you hope is going to happen, what you wish would have happened, right? Don't trade on any of that kind of stuff. Trade on what is actually happening right in front of your eyes. Trade what you see, not what you think. And I think some of the people that violate this particular rule the most are those technicians, those technical analysts that buy into chart patterns, for example, right? Because a lot of those people, what they're doing, it's all subjective. It's all their opinion. They won't say it is, but what it is, they have their own instincts and intuition. If they want to get long something or short something, what they will do is then they will draw a chart pattern basically to confirm what they wanted to do anyway. And again, they're really trading on what they hope, what they wish would happen, what they think is going to happen. They're not actually trading based on what that underlying asset that they're wanting to trade. They're not trading based on what it's actually doing. I think this is very dangerous. Again, trade what you see, not what you think. Now, if you want to learn more about trading and especially trading options, check out my book, The Super Wheel Option Strategy. In this book, I actually have a chapter titled Popular Trading Maxims, where I cover about 50 or 60 of these popular trading maxims, and I explain them in this book. So if this video has been enjoyable, again, check out my book. You'll find a link to that book in the description below. Peace, guys.